Why, hello, vetted VA, and welcome. My name is Hammer. I'm with Originator Success, and I am here to help guide y'all through the mortgage market and interest rates. Here for your weekly mortgage market update. If it's your first time here, welcome. Again, today is June 28th. We do this each and every week about this time, giving you some insight into what's going on in the markets and why mortgage rates change, how they change, which direction they're going, and all that good stuff. Just a nice neutral source of human information for y'all. Today's guest is going to be Chasity Graff. Chasity will be joining me in a little bit. So I'm going to go ahead and get started, though. We're going to jump in. If you have any questions, please feel free to go ahead and post them up here. Let me know what questions you may have, especially if they're interest rate related, or if it's about buying a home now. If you're here live, say hello. I see we do have some of you, somebody on the Facebook page, somebody on the whatchamacallit, on the YouTube. So there she is. Hello, Chasity.
Hey guys, sorry. I was trying to get the computer to work, and then it's just a balance of okay, what electronic device is going to work for me the best
Nope,
this
no
morning?
problem. Nope, no problem, no problem. So do us a favor and just go ahead and tell everybody a little bit about yourself.
Oh, I'm still wearing my Star Wars shirt. Sorry. So, hi all. My name is Chasity Graff. I am a broker and owner. I've actually owned LA Lending for 16 years this year. I know I don't look that old, but yes, I'm only 32. I
I
opened a
thought
company in my teens. It was craziness. But anyway, so I am kind of one of the original brokers that I know from way back when. And I run Louisiana. LA Lending is mine. And veteran loans are my passion. They have been for the last 8 years. I've done my very best to learn everything about the VA guide that I can, because although we are all licensed exactly the same, even the people that were licensed yesterday, that does not mean that we are all the same.
Awesome. Well, thank you for joining us today. Appreciate having you here. Remember, y'all, if you do have any questions for Chasity, we can just ask those, and we'll be keeping an eye on that in the comments. Also, if you're here on the replay, do us a favor in the comments, give us a hashtag replay. Let us know that you are watching. And if you do have any comments after the live show, we're still here to answer them for you. Just go ahead and put them in the comments after the replay and tag us, and we'll be glad to answer them. So, with that said, I'm going to jump in. Let us go right to the rate forecast, and we'll talk a little bit about rates, and then Chastity will start chatting about the market and all that good stuff. So remember, this is not an offer to lend, and when we talk rates, we're talking averages and generalities. Of course, you always want to make sure that you're shopping around and finding somebody that you're comfortable working with and all that good stuff. So looking at a quick recap, what happened, rates have been basically unchanged now over the last month. I didn't spell month, but that's okay. Moving up or down, maybe an eighth of a point. You might have seen some changes in your credit or cost to obtain a particular rate if you were getting a lender credit towards your closing costs, or if you were paying some money to get a better rate. Now, VA rates are generally in the mid to high sixes on average. Again, your individual results will vary depending on credit score, who you're working with, loan size, things like that. But you're going to find if you're getting quotes that are in the mid to high sixes without paying points, then that is, I would say, probably a pretty good amount. Remember, a discount point, or what you maybe, is 1% of the loan amount, and you can pay money up front to bring the interest rate down. So in this market, that's really up to you, but it's generally not something that you would need to do in order to get a rate in the mid to high sixes. Conventional rates are higher than that. They're in the higher sixes into the sevens. One of the nice things about VA rates, they generally are a little bit better than conventional rates. And rates really, like I said, they haven't improved much the last week with any of the data, the Fed meeting that we had a couple weeks ago. None of that has really made much of a difference. And as far as the forecast goes and where we're going from here, rates are not likely to drop much. And if you are out there house hunting, don't depend on rates being better. In the past, we've talked a lot about, this idea that with all these Fed rate hikes and with the rates moving up as quickly as they did, we were expecting to see a recession. And we expected to see mortgage rates move down. And quite frankly, I feel like a kid in the school where somebody's been pulling the fire alarm every day. It's just, a lot of fire alarms, but no fire. We're not really seeing any true signs of a recession. And a lot of the economic data that's coming in is showing the economy is still very resilient and doing well. And the labor market is very strong. And with those components, we're not likely to see interest rates drop anytime soon, and definitely not significantly. And when I say significantly, I mean more than 0.25%. So I think if you're out house hunting, it's a great time to be out there looking. I don't think you have to worry too much about rates going up significantly from here. Again, that would mean more than 0.25 point, but they're also not going to get better. The Fed is expected to raise rates again starting at their July meeting. It's about a month from today. They meet in July, September, November, and December. So they're going to meet 4 more times this year. And they're expected to raise the Fed rate in July, but that's already been priced into our markets. In other words, mortgage rates already anticipate that hike. And that's what we're seeing as far as mortgage rates. So if they do hike rates, you won't see mortgage rates go up that day, but you will see the Fed rate go up. And but one thing that is important is that Fed members have said that they think they're going to raise rates at least 2 more times this year. And markets are not anticipating that. Markets are only pricing in the idea that the Fed will raise that rate 1 time, which, that's where we may see mortgage rates creep a little bit higher if markets see that they think that the Fed will absolutely raise rates a second time. So we'll talk more about that in the coming weeks as we get closer. But we do want to be aware of that. And then, really to put it as in the simplest terms, over the next couple of weeks, rates really aren't likely to change much unless markets get spooked. And we want to keep an eye on July 7th, which is right on the outskirts of our 2-week mark here, where on July 7th, we're going to get jobs data. It's a big jobs report. If that report were to show labor market weakness, that could help rates improve a little bit, but that's unlikely. And if it shows more strength, that may be one of the catalysts, one of the factors that drives the markets to anticipate that second Fed rate hike. And we could see mortgage rates creep up a little bit from there. So keep that in mind. And, that's kind of what I'm seeing. Chastity, what are you seeing with mortgage rates and in your market?
Literally the same. I was going to agree with you on all the rate estimates that you gave with the discount points. One thing we always want to remember, though, is that a discount point is not necessarily 1% discount fees
Right.
based on a percentage of the loan amount, but one discount point does not equal minus 1% on the interest rate. And I think that that's a big thing that borrowers, we have to detail out whenever we're going through fee sheets.
Yeah.
Is you can pay like 0.25% to lower your rate 1/8 if that's what the rate sheet says that day. And whereas some lenders will offer you one rate and that's all that they have to provide, this is where differentiating lenders come into play, because other lenders have different rate sheets that they work on. Those rate sheets are all based on hedge funds that these lenders have, lines of credit that they're
Uh-oh, we lost Chastity altogether. Okay, I'm sure she'll be back, but let's keep going. And let me build on that a little bit. So let's go deeper this week. We've talked the overview of interest rates. And a lot of times people want to know, why do mortgage rates change? I mean, is this really an idea that there's just, 8 bankers around a round table that say, okay, this is what rates are going to be? And that's actually not how it works. And let me show you how it does work. What happens is that mortgage rates are actually based, and a lot of times you hear me say the market, they're based on the bond market and a specific type of bond actually called a mortgage-backed security. Now, right now I'm tracking mortgage-backed securities, and I'm tracking a particular security, which is a universal mortgage-backed security, and it's a 5.5 coupon. What this means is that if we were to buy this bond for $100, right? If I have $100 to spend, and I say, okay, I want to buy this coupon for $100. What does that actually do? How does that actually look? So what happens is I buy a $100 coupon. In 30 years, right, I'm going to get my $100 back. I'm putting that money up. It's like a CD, if you will, right? I'm putting that up. And in 30 years, I'm going to get that money back. But over the life of the 30 years, I'm getting it an interest rate of 5.5%. So I'm going to get a return each month of 5.5%. Now, this is not guaranteed, though. That's where it's different than a CD. This is not guaranteed money. When I buy this bond, that's the anticipated return, but it might change if people prepay or if they close, and the value of that bond is based on that payment schedule and that prepayment. So what happens is right now 5.5% is very close. It's 99.98. It's very close to 100. So it's going to cost me $99.98 to get that $100 bond. Well, what if I want a higher interest rate though? Well, we can look at the 6% coupon, which is going to give me, instead of 5.5% every month, it's going to give me 6% every month. The problem is that's going to cost a little more upfront because I'm getting more interest over the life of this bond. So it's going to cost me more money now in order to get that extra money over the life. So I'm going to pay $101.14 to get that $100 worth of bond today. So that's called a premium. And as that premium rises and pays more, well, mortgage companies that are delivering these loans are also getting paid a premium on what they're delivering. So if they deliver loans that meet these criteria. So what happens is, depending on the premium or the discount for selling, that's how mortgage pricing comes about. And mortgage rates are based on the actual pricing. So what happens is, when a lender is actually lending out money, they would run out, right? I mean, eventually, if they lend it out, they're going to get some back, some prepayment, but they're going to run out of money. Well, how do we keep that money being replenished? Well, what happens as a mortgage lender is, I'm going to lend out my money, and I'm also then going to sell that paper to the back end in what we call securitization. And that's where Fannie Mae and Freddie Mac and Ginnie Mae all come into play. And I'm going to sell that paper. I'm going to sell that mortgage on the back end, and that's where it's going to go ahead and be securitized, turned into these mortgage-backed securities, and investors like insurance companies, state pension funds, other countries even invest and buy these mortgage-backed securities because of the return on investment and the safety of them. They're generally, the only thing safer than mortgage-backed securities is a U.S. Treasury, which is has the faith of the U.S. government on it. We had that whole debt ceiling drama, but as usual, it got taken care of. We've never defaulted on our debt. The U.S. does not default on their debt. They're like the Lannisters. The Lannisters always pay their debts, right? And you guys, come on, there were some Game of Thrones fans out there. I know you were. But that's how all this stuff works. So anyway, if you see this all coming on, this is kind of how the changes that you see in mortgage rates come every day, sometimes within the day. And it's all based on this actual market movement. That's why we track this stuff, all these fancy candlesticks and charts. For you, as a consumer, if you wanted to have something that you want to, just as an idea, watch the 10-year Treasury yield. And you can even Google 10-year Treasury yield. And you could go ahead and, like on CNBC, you could just go ahead and watch and monitor that 10-year Treasury yield. And this is not what your mortgage rate comes from, but it is a very similar financial instrument. So what happens is, if we see this yield go higher, then generally mortgage rates are also going to move higher. If we see this yield move lower, generally mortgage rates are going to move lower. And as you can see, this 10-year Treasury yield has been near 3.72 going back now to May 22nd. So May 22nd, June 28th, it's been about a month that this 10-year Treasury has been right around this 3.72 area. And you've seen mortgage rates that have stayed right around the ranges that we've seen for about that same period of time. So when you see this yield, if you were to see it drop significantly, well, then mortgage rates should be getting better. If you see it go up from here, mortgage rates are likely to get worse. All right. So that's just some things that you can be watching, and just to get an overall idea of what you as a consumer can monitor to see, if mortgage rates are changing. Again, it's not always in lockstep, and it doesn't mean that if the 10-year Treasury goes to 3.70 tomorrow, that your interest rate's going to get slightly better. It's not that exact, but it is a very good overall indicator, something that you can monitor. So I'm going to keep an eye on the comments. I see we do have a comment. Somebody is live. Welcome. Glad to have you here. So anyway, that's what we've got going on today. Let me know if you guys have any questions, if you want me to go deeper on this stuff. But otherwise, I know it's kind of boring that things have not really changed, but the good news is that they're not likely to change. And what this does is this adds a lot of stability to home prices, because right now we have a problem with inventory, and that's been a problem for years, not even months, years. And the problem with inventory is there's just not enough houses on the market, which means that there's too much demand, and that when a house is on the market, it goes very quickly, or it goes at asking price, or maybe slightly above asking price. Now, there was some time where people's asking prices were getting a little ridiculous, right? Because the market had been jumping so quickly, and that's kind of curbed down a little bit. In other words, somebody that whose neighbor, maybe my neighbor sold a house similar to mine for 300,000, and my real estate agent said, "Hammer, you can get 325,000 for yours." So I listed my house at 325, but it wasn't selling because things were starting to slow down a little bit. And maybe I dropped it back down to 300,000 and sold it at 300,000. So there were a lot of headlines about how the asking prices had been dropping, but they're really, we have not seen a tremendous change in actual sales prices and values. Those have been very, very solid. Buying a home right now, still a very, very good move. And buying a home, listen, we all would have loved to have gotten interest rates at 2.5%. I know that, right? During the pandemic, but those rates are not going to happen again unless we have something catastrophic, black swan type event like the pandemic. The only reason we saw interest rates drop to that level was because we shut down the economy. We forced people to stay home, and the Fed had to get everything moving again. They had to keep money moving. And what they did was they artificially manipulated the market. They pushed interest rates very, very low until we got things going. Then what happened is we overheated, and inflation got up too quick. Then the Fed put on the brakes and started raising interest rates dramatically to slow inflation down. Inflation's still a problem though, but coming down. And that's why the Fed is likely to hold where they're at. They're waiting to see if things equalize. We get a better equilibrium. And we're not likely, like I've said before, we're not likely to see rates drop while there is still a strong demand, while the housing prices are stable, while inflation continues to be an issue. We don't have deflation. We have disinflation, which is lower inflation, and that's okay, right? We still want to see some inflation. So it's a healthy economy, a very healthy labor market. Because of that, you're not likely to see interest rates drop significantly. Home prices, very stable. If you're out house hunting, you don't have to worry about a housing bubble. There's not anything that we've seen that's very similar to that. We are not in a housing bubble. We've talked about this before. And right now, even though rates are, they're higher than they were, but this is historically, this is a normal rate environment to have interest rate in the sixes, maybe even in the sevens. And it does hurt the buying power. I get you, folks. I feel you. It makes it, you're not able to buy as much home as you may want. It's going to make it so there's maybe less home inventory in that price range because it's the sweet spot. Many of us are in that same price range. So inventory still very quickly. There's still a lot of competition for homes. The good news is that when you do get the home or buy the home, you're very likely to see this home increase in value over time from here. It's going to be a way of creating wealth for your family. You're leveraging the bank's money to increase your own wealth. And this is a good move. So anyway, that's it for today. I'm going to wrap it up unless you guys have any questions. I'm sorry that we did have some problems with Chasity. I know we'll have Chasity on again. Chasity, we missed you. I'm sorry about the tech issues, but we will definitely get you back on. And let us know if y'all have any questions. Put them in the comments, and we appreciate you. Take care, everybody. I will see you next week. Remember that you can join me each week to discuss mortgage rates. 700 Central, 1000 Mountain, 900 Pacific. So we do this each and every Wednesday, and I will see you next week. Take care, everybody. Bye-bye.